welcome. You're watching Managing Money with Moneycontrol. I'm Sakshi Batra, and this is the second part of our budget takeaways series. Now, we've talked about the differences between the old and the new regimes to really help you decide which one should you adopt in the first episode. And now we are going to be discussing about how the tax changes would really impact your investments. Joining me to give us more clarity on the tax announcements is Ms. Preeti Khurana, Chief Editor of ClearTax. Thanks a lot, Preeti. It's good to have you back in our newsroom at Moneycontrol. Let's begin by asking about dividends especially. Now, we know that earlier companies used to pay 20% tax on the dividends that it used to shell out to the shareholders.
Right.
Now, it will be taxed on the receiver's end.
Correct.
So how does this life change for, say, shareholders or even for mutual fund investors?
Right. So earlier, like you rightly said, companies would deduct dividend distribution tax and then pass it on to the shareholder.
Yeah.
Now that dividend distribution tax has been removed, it means that shareholders will maybe receive slightly higher dividend.
Okay.
And then they will pay tax on this dividend as part of their total taxable income.
Okay.
So shareholders will have to make sure that whatever dividends they are receiving could be from an company or could be from a mutual fund is included in their total taxable income.
All right. And there's also some announcement on the TDS front.
Right.
So further, the 10% TDS will also be applicable to the dividend if it is from one particular house and if it exceeds 5,000 rupees in a particular year.
That's right.
Okay.
So what they've done is they've said that now this is taxable in your hands. If you are an equity shareholder, then you're going to keep track of it yourself. It will reach your bank account and then you will sort of include it in your total income. But if you are a subscriber to a mutual fund and the mutual fund is paying you any dividend and that dividend exceeds rupees 5,000 from that particular fund house, then that fund house will make a TDS deduction of 10% and pay you the dividend net of TDS.
All right. All right. Could you also give us some more clarity on the withholding tax that mutual funds are going to be taxing?
Right. So TDS is the withholding tax, and that's going to be 10% if it exceeds rupees 5,000.
So that's the only difference that it has happened from the previous regime as well. All right. Now, there is a whole lot of debate that actually started from the time 2018 when we saw the long-term capital gains tax was introduced between as to investors whether they should go for ULIP since they do not attract any LTCG now, or should they invest in mutual funds because they actually now attract taxes. So what is your take on that, and how does it change for investors who have ULIPs and for investors who have mutual funds right now?
Right. So if you are a subscriber to a ULIP, then nothing changes for you really. You always had to pay taxes at the time of withdrawal or maturity, and that was dependent upon just the way insurance policy works.
Right.
But in case of mutual funds, now you have taxation of the dividends as well. So a lot of investors may need to refocus on whether they want a mutual fund which gives out dividend or should they opt for a growth option.
Exactly, and that is what I was coming to as to whether do you think that the dividend plans in mutual funds, they will lose Sheen because as against the growth ones because that is more tax savvy?
Right, correct. So I think if as an investor you are able to hold on for a longer period of time, you can hold it beyond 12 months and you don't need the dividends immediately, then you would greatly benefit from being in the growth regime. So, go for the growth option and stick to your investment. Dividends will not only face a TDS and then they'll become taxable according to your slab rates, but if you go for, the equity option, the growth option, then you will face LTCG tax. So you need to kind of, weigh these two options and then go for it. But it seems that, your returns would be better and your tax incidence would also be lower if you were to stick with the growth option.
All right. Let's actually move on to another very important asset class, and that is the housing sector. Now, I remember, Preeti, when we were discussing in our podcast before the budget was announced, we did discuss about the expectations from this sector, and there were a whole host of expectations on the increasing in the limit of the interest that I get on home loans as well. But nothing on that front has been announced. But if you really ask about the affordable housing sector, there has been some announcement. Also for the realtors or the developers, there has been some increase in the tax holiday. So could you break that all for us and also tell, how does it change life for maybe people who have home loans right now and also for developers?
Right. So interestingly, they've decided not to touch the more popular deduction, which is the rupees 2 lakhs that people would claim on interest on housing loan. But what they've done is that they've touched the section 80EE which is a very specific section for affordable housing, and it's only applicable if the total value of your house is less than 50 lakhs and you have a loan amount in the range of 35 lakhs.
Right.
So it has various restrictions. My guess is that they've done it. They've just extended the duration until which you can take benefit from this scheme, and they've passed on a similar benefit to the builder so that he can claim deductions if he's building affordable housing. But surprisingly, this deduction was launched some time back, and if they've extended it, perhaps they should have done some number crunching and shared that with us, that how many people actually benefited from this scheme. It doesn't seem to be really so, because there is a slump in the real estate market and people don't seem to be picking up or going for this affordable housing deduction as such in their tax returns. And it also complicates the matter further, like we discussed previously. There's this old regime and the new regime. So this adds another dimension to your whole deduction, and this 80EE is actually on top of the rupees 2 lakhs you claim. So if you meet the conditions of affordable housing, the cost of the house and the loan amount, then you can actually take your total deduction to the rupees 2 lakhs plus the additional deduction available under 80EE. So you can really benefit from it if you opt for it. So somebody needs to do that kind of math, if they want to buy a house and look at what is the value of the house. And then if they are able to take up their deduction to 3.5 lakhs from both the sections, then they would really benefit.
All right. So the affordable housing segment, there is still something, but overall there has been larger disappointment for the sector because a lot of expectations were not met there. But let's ask about the googly that actually came in the budget, and that was on the NRIs front. So are NRIs going to be miffed with this budget 2020 completely? What was in it, if you could just break down the complications that were announced over there on the definition changes and stuff like that. And also, as far as I understand, the government really has the intent clear that you have to pay tax somewhere.
Right.
Yeah.
Okay. So, I'll just try to talk very simply around the changes in the NRI status rules.
Correct.
So what the government has really done is that there is a specific condition where it says that if you are an Indian citizen and you come on a visit to India, or if you are, an employee and you're sort of leaving India, if you're on a member of a crew of an Indian ship, then if you spend, say, more than 240 days in India, then you'll become a resident of India.
So
and
maybe
earlier
the
this was 182
Globetrotters.
days.
Okay.
Yeah. So now, if you're an NRI and you're coming on a visit to India, you can stay for a maximum of 4 months. You cannot stay for 6 months because then you'll tend to lose your status. So it's actually a more restrictive clause. They're trying to restrict, the benefits of NRI status to you. So just put very simply, they're trying to restrict you by, the number of days you stay in India is being cut down so that, to be able to hold on to your status, you stay here for a shorter duration. That's the summary of it. The other change is that they are saying that if you are an Indian citizen, but you stay in many countries, you're spending 2 months in one country and then 1.5 months somewhere, and you sort of are not a tax resident of any of these countries, and you are an Indian citizen, then you shall be deemed to be resident of India. They've tried to clarify this, but in my view, a lot more clarification is required as to how this is really going to work. Because, incomes which are earned in India from, let's say, rental income from a house property in India or a business run in India, such incomes are always taxable in India, even if you are an NRI. So that has always been the case. But if they want to tax such income, a person's income who is an Indian citizen from anywhere on the globe, well, that needs to be seen how that is going to really work out.
Absolutely, and one really needs to find out whether the government's intent is actually to catch hold of the NRIs who've actually run away for right or wrong reasons, or for those people who are genuine taxpayers as well. Thanks a lot for joining us, Preeti, and sharing all those insights with us on this episode as well. So we really hope that all this has broken down things for you and made things simpler for you as far as the tax announcements are concerned. And with that, it's a wrap here on this two-part series of the tax takeaways from Budget 2020. Do write into us at moneycontrolpf@nw18.com with your feedback and comments. Many thanks for joining us.